Hello and welcome to the weekly educational webinar from ICM.com. My colleague Sai Mahesh and I would like to thank you for joining. We chose today to talk about how you can create a trading strategy and minimize your risks by adopting certain money management techniques. Well, it's very easy to create a trading strategy. This is just like combining a couple of indicators together, but first you need to know what every indicator signals, and that's why we've been explaining about technical indicators in the past couple of webinars. We covered a variety of indicators and the technical analysis techniques that you can follow in order to have better understanding for the market and better decision making. So it's easy to create a trading strategy, but what's hard is finding or creating a profitable trading strategy. Here comes the performance or the knowledge that you need to have in order to have a better assessment for your trading strategy in order to reach a proper one which would generate some profits. So in order to create your trading strategy, you have to first answer a couple of questions. First, what type of trader are you, or what type of trader do you want to be? So there are different types of traders. There are those who are day traders, swing traders, investors, scalpers. It all depends on how much time you can give for trading, or how much effort can you put in. So this will have also to do with your risk assessment or risk sentiment or risk appetite. So if you're willing to take more risks, or you can afford more rush in the market, maybe you can choose being a scalper or a day trader. If you can't afford this rushness or a little bit of hectic times, you better go to swing trading, or if you choose to take more long-term trades, you're going to be an investor or a position trader. We call it a position trader. So first you have to choose which one are you. The day trader decides to take trades through the day, to enter and exit the market within the same day, and not keeping any trades for the second day. A swing trader will take will have a trade which might take up to maybe 2 days, 3 days, up to 1 week. So he believes that there's a swing in price that's gonna take place, and he trades the swing. Also, investors or position traders, they do sometimes wait for they more rely on maybe some fundamental analysis, since fundamental analysis will help you in figuring out which currencies or which stocks or currencies are mispriced, and the market's going to price them in the coming weeks or months. So usually investors would go for these trades, which take much more time. So also this is one of the types of traders: position trader or an investor. So first you have to choose this one. And the scalper, it comes in also as a day trader, but a scalper also might take, for example, a day trader might take a trade for 20 and 30 pips. A scalper can enter the market and exit for only 2 or 3 pips. So he has a higher frequency of trades. So this is the first question that you need to answer yourselves. The second one is, which markets are you willing to trade, or do you want to trade? You have the currency market, the FX, you have stocks, you have stock indices, which is related relatively to stocks in general, commodities, bond markets. So it depends on also which market you are willing to trade. Each market has different characteristics, and especially the leverage that we use differs between each market and another one. So also this is one of the key questions that you need to answer yourself before moving into making or creating a trading strategy. Then you have to decide which trading style do you want to adopt. There are two types of mainly all the types of all trading strategies. They come under two main or two big categories, whether either range trading or breakout trading. So the market is either ranging or trending. We have three, either uptrend, downtrend, or range trading. So these are the three statuses that the market would pass through within a day, within a week. It all depends also on the time frame. So we have two categories: range trading and breakout trading. What is range trading and what is breakout trading. You need to know because most of the technical indicators that you need to that you can use in order to generate signals for your trading strategy can give you both signals. Can give you a signal if you are willing to trade in a range, or can give you a signal whether if you are willing to trade a breakout. So that's why you need to make sure you know what is the trading style that you want to follow in order to have better acknowledgement from the technical indicators. So what is range trading? It is a strategy where a trader identifies overbought and oversold levels. Most of the indicators, most of oscillators would give you an idea whether the market is overbought or oversold. So a trader who is willing to trade range would buy an oversold market and sell overbought markets. So they believe that the market is going to reverse back to the mean, to where the market was trading in the middle. So if the market goes to an extreme, for example, if the market rises sharply, they will start looking for places to short the market and trade it back to the mean, and vice versa. If the market is dropping sharply, they will look for levels to buy and go back to the median or the mean. So this is the range trading. It is very profitable when the market is moving sideways without trending. And in trending markets, a trader would have been stuck with a certain trade if they are relying they are willing to hold a position or to build a position. Usually, traders who do range trading, they try to build a position so they don't have like a solid stop loss for a certain trade. We're gonna give some examples on the MetaTrader for those who work with range trading and those who work with breakout trading. So this is what you need to know about range trading. Moving to breakout style. A breakout is a price of it happens when a price of a financial instrument moves outside a defined support or resistance level with significant volume. So let's say we have a psychological level which is acting as a resistance. Let's say, for example, gold at 1800. Let's take the high 1818 as an example. So at 1818, the price reached 1818 and then reversed back towards almost 1790. So currently, traders will look at 1818 as a resistance level, as a tough resistance level, and they will look how the price will react when reaching again 1818. So a breakout trader would look for a break above 1818. So if the market moves above 1818, he will be looking to buy again with the market to, and move forward or hold the trade towards the next resistance level. And on the other side, for example, let's take into consideration one of any of the dropping markets. Let's say USD CAD was dropping towards, let's say, 130 135.70. So when the market is moving down for a certain support of 35.70, let's say, so they believe that the market's gonna is gonna have a break below 35.70 and move towards lower levels, for example 35.20, 35.10 or less. So a trader will be looking to sell the market when the price clears the support zone. He believes that the sellers were stronger than the buyers and they are able to drive the market lower, so he will be joining this trend. So this is what's called a breakout trading. A breakout trader would buy after the price breaks above resistance and sell if the price moves below a support level. And a trader, it depends here, the profit taking can depend here. Maybe a trader would be looking for a small return on his investment side. Later we'll talk about the risk to reward ratio and these money management techniques, or these risk management techniques that you have to follow. So a trader could be looking for just a couple of pips on a break of certain support and resistance, and also he could be looking to add on an existing position and driving towards or what we call riding a trend. So a trader would be looking to ride a trend and during breakouts, so he'd be adding to his position. So these are the two trading styles that mainly all the trading strategies are under. So now moving to the next step, after choosing if you want to be a range trader or a breakout trader, you gotta choose the indicators that will give you the signal to trade, or will give you more information about the status of the market, so you'd be trading in a better manner. So this is for indicators. We have different types of indicators, and you have to make sure that at least you have one indicator of each type to in your trading strategy, because you need more data in order to trade. You can't just have a trend indicator. You need to have a trend indicator, you need to have a momentum indicator, volatility indicator, and the volume indicator, because each one will give you a certain information that you need to know about the status of the market. And when you combine the outcome of these four indicators that you are using together, you would be in a better trading position. So let's list some of the trend indicators. You all know the moving averages with different types. You have the simple moving average, exponential, smoothing, smooth, linear weighted. You have different types of moving averages. They can tell you the trend. If the price is moving above the moving average, it is the trend is up, and if the price is trading below the moving average, the trend is down. We have also the parabolic SAR. If the price is trading above the SAR, it means that the trend is positive, and if the price is trading below the SAR, it means that the trend is negative. Also, we have the MACD. The MACD can give you two signals, either the crossing of the MACD line and the signal line, and also it can give you the momentum when these two moving averages, or the MACD line and the signal line, are going far away and the histogram is growing. So also it can be a trend and a momentum indicator. Moving to momentum indicators, we have the famous relative strength index. Investors would be looking for overbought positions, overbought markets, when the RSI, for example, crosses above 70 or above 80. It depends on uh, their risk appetite, and they will be looking for oversold markets when the RSI moves below 30, 20, 15. It depends. Also, they can choose the level that they want. Also, there is the stochastic oscillator, so they will be looking also for maybe some crossing above. They can take the signal from the stochastic with a crossing above, let's say, the 80 level. They can start entering a short position, and also they can look for buying a certain instrument when the cross happens below 20. So also this can be given from the stochastic oscillator. Also, there's a commodity channel index that gives us a state more information whether the market is overbought or oversold. Also, moving to the volatility indicators, you can choose the Bollinger Bands. You know, the bands, the upper band and the lower bands. They can tell you about volatility in the market, since the Bollinger Band is just a deviation and the moving average. The middle band is a moving average, and the upper band and the lower band is a standard deviation from the middle band. So when the bands are close to each other or converging, this means that the volatility is low, and when the bands are very wide or diverging from each other, this could mean that volatility is rising. You can also use the standard deviation indicator itself that's found on MT4. When the standard deviation is rising, it means that the price is moving away from the mean. Also, you can use the average true range, which gives us a signal or hint whether the market is moving significantly, or there is a little bit of moves in the market. For example, an ATR, an average true range, or a difference between high and low for a certain instrument. Let's take into consideration the euro. If the average true range of a single day is, or the difference between the high and the low is more than 100 pips, it means that the market is more volatile than the market which trades almost 20 pips a day, the difference between the high and the low. So also the average true range can give you uh, more information about the volatility. And from volume category, you can select the unbalanced volume that's also found on the MetaTrader 4. So when the market is moving, as we said, the breakout trading relies also on the volume. So when the price is breaking away from a resistance zone or a support zone, usually traders would monitor the volume, and they can monitor the increasing volume or the decreasing volume on the unbalanced volume indicator. So these are the four types of indicators that you must have inside your trading strategy. Now let's move to the MetaTrader 4 platforms to have a little bit more of the practical outlook on what we've been mentioning. Okay, so let's use the gold as the gold chart. and talk about it. So here it's very straightforward. So as we said, first we have to select a trend indicator. So let's go for choosing any moving average. We're gonna use this moving average. Let's take 100 exponential, or let's take it a little bit. We can have more than one moving average, and also this could give us a trend, and also could give us momentum. So here we can see that when the moving averages are widening from each, or the difference between the moving averages is wide, this means also this could give a signal that the market is moving in an extreme. Here, when the moving averages were widening, we can see that the market reversed from this top. So also the difference between the moving averages, or the distance between the moving averages, could be taken as a signal for momentum. So also you can use this. Now, after choosing the moving averages, that can give us the first tick. So the first tick is choosing whether the trend is going up or the trend is going down. So this moving average is telling us that the trend is up. Gold is moving up. Now we move forward to choose an indicator that this is the parabolic SAR that we talked about a while ago. Also, you better choose a bigger, you better choose a smaller deviation that can give you more. It is of course a bit far from the price, but it can give you the general direction of the market more than the one that is with the small period. It is more deviating than the ones with a longer uh, distance. So this is a trend indicator that we're using currently. Now we have to go to choosing an oscillator or a momentum indicator. Let's choose the RSI. So the RSI here is telling us if the market is moving above 70, for a range trader will start building a short position here. So sometimes a trader is looking for those who are looking for a reversion to the mean. They know that the market is up, the trend is moving up, but they will start looking at first the difference, or how much the price is away from the moving average. If the price is away relatively to the previous history, or the previous price performance, they would start comparing the current era with the previous one and looking for short positions. So those who look for range trading, they have a certain consensus for the difference between the price and the moving average, and they will look for the RSI. The RSI is signaling over both. The price is moving above, the RSI is above 70 and moved to 88, which is extremely high. So a trader who's building a position to for the price to reverse towards the mean, he will start taking short positions. Let's go more conservative. So we have to choose bigger levels for the RSI. So let's go for 20 and 80. So if the price starts crossing above 80, they can start building a certain position in every close of a candle. And another more conservative approach could be when the price moves back below the 80 level. So here's one of the uh, of the examples. So let's say the price here is moving below the 80 RSI. So it was here within this candle. So when this candle closes, they would short a position here at almost 1556, and the price went down through the same day towards 1540. So this is how a trader who's looking for a reversion to the mean trade will start looking for a certain trade. Also, if we have to add the average true range, or the ATR, if I'm gonna add the ATR, it will allow me to set my take profit and my stop loss. For example, the ATR here, it was 19, almost 19 to 20. So I'll start looking for a trade that could give me maybe 25% of the ATR, 50% of the ATR, 75% of the ATR, or the ATR itself. So the ATR could be used to trigger the stop loss and the take profit levels. I can use the ATR since it won't be, if I'm a day trader, it won't be logical to look for a $50 move in gold when the average true range is around 19. So I have to be more logical and look, for example, for a $5 move if the market is moving $20 per day. So this is a small strategy. By combining these three indicators together. Another approach for those who are looking for a breakout, for breakout trades, they could start buying, for example, if the RSI, they'd start looking for more uh, conservative levels, they will start buying if the RSI, let's say, crosses above the 80 level. So, and the trend is up, so the price is moving above the 100 and 200 exponential moving average, day exponential moving average, and the RSI crossed above 80, so they initiate a long position here, and this is what happens. So a trader would have bought near 1517 as the price crossed above 80 and the market rallied towards 1610. So here it depends on how he will adjust his stop loss. Maybe he could have a trailing his stop loss and to secure the gains as the market goes up. So this is in brief how we can use the technical indicators to have either a breakout strategy or a range trading strategy. So this is the one of them is moving with the trend, another one is counter trend and moving towards mainly reversion to the mean. It comes from a theory that the market moves away from a moving average and then comes back to it. If we go back to the chart here, we can see as the market moved away from the moving average, it then went back and came back to it. Here we can see the market moving up and then to the middle, down and then to the middle. So those who are trading inside the range or reversion to the mean, they would have made a lot of money trading this range. As the market went down and the oscillators gave oversold positions, they bought towards the mean. And as the market moved up, they sold towards the mean. So here they got a couple of good trades. And then here, when the market was able to break out of this trading range, they would be losing money. So they have to deal with their losing trades. Maybe they have a certain strategy to deal with their losing trades. Maybe it's very crucial to have certain position sizing. If you're not having a stop loss for each trade and you're relying on a recovery system, and this recovery system depends on the volume size that you're taking in the second, the third, the fourth, the fifth trade, it all depends on this a volume sequence that you should be using. Some of the traders do use the trade size for different trades. Some traders do use martingale. For example, they have a multiplier. The first trade is 0.1, the second is 0.2, the third is 0.4, and then 0.8. They multiply the trade size by 2. Some traders do use the Fibonacci sequence. For example, 0.1, 2, 5, 3, 5, 8, 13. So they choose different sequences, but what you have to make sure is that the sequence that you are following is helping you or saving you from what could be a nightmare for your account. Also here, so as we said, the range trader would have made money here, and the breakout trader would have lost money here, since they were if they are looking for a breakout above this support zone, they would have a fake signal, but also they can trade the deviation away from the moving average. Here we had some good trades for a breakout trader, but if they are seeking a move higher towards higher levels, maybe they witness profit in their trade and then maybe close their trades at break even. However, a breakout trader also would have made money here in this position. So it's always about the market. As we said, market 70% of the time moves inside the range, and the rest it would be trending or breaking out. So you better choose which style you want to trade. You better choose the proper technical indicators. You better have good knowledge or understanding on how these indicators move, and you could create your own trading strategy. It's better currently nowadays, since it's very easy to create expert advisor or automated trading systems. It's better to write down your rules, your execution rules, your filtration rules. Once you write down all these rules, you can execute them, and then you can go for the backtester here on the MetaTrader 4 platform, and you can backtest your trading strategy. And once you have, for example, you backtest your trading strategy, you can have a report, and this report will show you all the details that you need to know about your trading strategy: the performance, if your strategy is winning or losing, the drawdown, how much of the trades were profitable and how much were losing, what's the average profit trades towards the average loss trade. So I will now talk about the risk to reward. So this is very important. How many trades are you losing consecutively and how many trades you are winning consecutively? So this report is a must if you are if you are assessing your trading strategy. Also, you can always go for manual backtesting, so you can just look at the chart. You can you can just write down your positions. If, for example, you are trading a breakout, you say you write that you just took a signal for a breakout, and you write all the rules that you took or you used in order to enter this trade, and whether the trade was successful or not. So this is very important to write down always your rules. So this is mainly how you can create your trading strategy. If you have any questions, we will answer them when Sai finishes his part. So now Sai is going to explain how you can use money management in order to lower your risks. And from my experience, I tell you that money management is one of the key pillars in trading. It is really a key pillar, since sometimes you exit a very good trade, a very good position, because you are oversized. So always make sure to have proper sizing relative to your account that could make you feel more comfortable holding a trade towards achieving your trading goal. So this is all from me. Now Sai will explain about the money management. Sai?
Thanks, Wael. Uh, Hello to everyone. Hope everyone is doing good. It was a great and a neat explanation regarding how to create the trading strategy from Wael. And as you were saying, like management also plays a major role when you want to create your trading strategy. Because when you are planned to have some technical indicators, you try to keep some strategy with multiple combination of your technical tools. But besides that, you have to make sure that you have properly managing your money with risk. That's most important things. If you have failed on this, so definitely you're going to see many failures on your trading. So basically, when you're talking about money management, it's one of the a key concept to long-term success for any financial markets. Unless you have a proper money management or risk management, it's very difficult to develop your portfolio for the long-term runs. There are few factors which I've been would like to share here. The major, like how to manage your trading risk. So which I kept here, like there are many, but this few things. So where we're going to discuss not everything over here, because like we have to take in highlighted points and highlighted important factor which really to consider how to start a trading. It can be a beginners, a mid-term traders, or a experienced traders, whoever may be. A money management is must to follow. So where we see that here, the few are important factors like risk to reward ratio. That's a ratio which you're going to discuss. The percentage risk method, scaling into a trade, choose a proper leverage, and regular check in trading journals. So now we are going to see one by one. So how this is going to be useful for you, where I'm going to share some more examples along with this, like you may face in your trading, or you're going to face, so which really helps you to understand how exactly the money management to be implemented to give a result. So let's talk about a risk to reward ratio. So it's basically a fundamental idea in any fundamental idea in finance, like it's a relation between the risk and returns. So as you said, like without risk, there is no returns. So everyone knows about it since you've been trading in the markets, for any markets. That's how exactly the reward gives you. So the greater the amount of risk that an investor is willing to take, the greater the potential returns, as vice versa. So as you know, like you take more risk, you take more returns. So less risk, less returns. The same way, without risk, they can't do anything. The reason of this, that the investor need to be compensate for taking additional risk. So when you take more risk, and you're going to develop your returns accordingly based on your capacity. Usually the risk to reward ratios basically works with a ratio of the common ratios. It's depend on your risk capability, how you handle it. But namely, like this is a very important point to be considered, an important point to be followed, as how much risk you're going to take. That means like they are risk ratio with 1:2, 1:3, 1:5 ratio. These are minimum risk, and it's a normal risk which you can adapt to get into the trading. Choosing this risk reward ratio with support resistance of the trend. Even some people, some traders, or many few traders are been used to follow the risk reward based on the support resistance, whereas while was showing you can be adaptive trading along with the support resistant breakouts. Are talking about the breakout levels like buying and selling levels. Based on that, you can keep your stop, or maybe you can take a risk based on this. So avoiding trading entries if your risk ratio is not enough. Basically, if you're not able to capable take a risk. So, for example, you're able to take a risk of $1,000 out of $10,000. So, if it's the risk is showing for you more than 2,000 or 1,500 or maybe 3,000, I try to avoid this kind of entries. Basically, this is control your risk unless you get in the market, jump to the markets. Basically, the risk is more, so obviously the maybe reward is more, but think the risk is a multiple for you, when you get the opposite side of the market, when the market reverses on the side. So these are the major things about it. When you're talking about the percentage risk method, which is mostly correlated with the risk ratio method. The percentage risk method is a method accordingly to which your risk is same fraction of your account balance as a percentage per each trade. So that means you're going to take your lot, maybe you can take your positions based each and every trade based on your balance. That's most important thing. Many traders do mistakes. Many traders accumulate the mistakes when they are over trade. That means that they trade more exposure, equal and 100% of the risk of their margins. That's a major reason you get a small move in the markets like ups and downs. So definitely it will be come to your a big a risk out to the accounts. So calculating each position that determine the risk based on your account size. That's what I'm saying. Like the size is very important. Based on the size, the position should be proportionately to be taken according to that. So there we are going to see some examples. That means the number one risk is known as drawdown. The drawdown is nothing but the money which you've been lost in your account. That means what a loss accumulated on your account that has been mentioned as in the name of drawdown. So now we are going to see a small example how exactly this risk method, the percentage risk method is placed. For example, you have an account of $10,000 and your risk is like a percentage risk you want to take is 10%, 5%, and 2%, which I've been defined here in the table. Like you can see the risk of each trade will be like $1,000 in case of 10%, in case of 5%, which is going to be $500, in case of 2% is going to be $200. It's very important, very much potential point to be notified here. That means like each and every trade, what you're going to trade on the market, along with a balance of $10,000. I'm giving an example here. So which I keep as 10,000 as an example as a balance. So if you're taking a watch in every trade, one trade, if you are going for 10% of risk on each trade, that means like $1,000 is a maximum loss which you're going to take for the trade. So keeping this as a major ones, where I'm going to give a small examples here. So keeping with the $10,000 in your account, let's keep your plan to take a 2% of risk. So risk doesn't mean like, it's a percentage, it's matters, but still it's depend on your how capable you take the risk. So suppose you have a balance of $10,000 with you like to take a risk of 2%. So where I'm taking an example with the Euro USD pair. So in case that like 2% of risk is about $200 from $10,000. So each peep value is like a $10 more. For example, one peep movement, which is gives you a $10. So in Euro USD with a one lot size, for example. So using like a 1:2 ratio, which I showed you, like we can keep your ratio depend on your capacity. Then your stop loss will be 20 pips for, and your take profit is 40 pips. That means you are giving a double your profits and you're keeping your stop loss with the 20 pips. That means 40 pips is your profits and your 20 pips your risk. So it's completely understandable and sensible way which you are taking a risk here. So in case you have failed, suppose your market goes against you, your loss is going to be $200. In case your success, I mean your favor to the markets, you're going to win about $400. Hence, the risk is still 2% within the same, it's 1:2 ratio. So when you're using this ratio system, or a ratio type of formulas, I mean, the ratio type of strategy which you're going to implement, so definitely you have to follow strictly on this. So based on the lot size, the risk is going to be defined. For example, you increase the lot size like one lot into the two. Basically, that's going to be double your loss as well as you're going to double your profits. This is how exactly a small example I've been sharing with you. So let's move on to the next one, scaling into a trade. So basically, like, this scaling into trade is normally money management systems. So everyone be facing this, may not be knowing the word like scaling. But normally what happens, most of the traders who like to go for averaging the positions, like, whenever the markets goes down, keep averaging the position. When the market goes up, sometimes, the try. Here, what happens, the scaling is method of money management. Allow you, basically it's allow you to limit your potential loss and maximize your potential profits. That means how to increase your profits, profit, how to control your loss. The scaling means gradually increase or decrease the value of your position while trading. For example, you are a aggressive trader or you're a risk trader, based on what other strategy you follow. You have a very good trading strategy. You are following very good indicators, the oscillators, and implementing all the ratios of risk. Even though like you like to increase your profits, for example, you are been get into the market in some levels. I mean, you're start trading up like 5 lots or maybe 10 lots or 15 lot, whatever maybe. It can be even 0.01. It can be start from 0.01 also. So that's how exactly you increase the lots. For example, when you start increasing a lots, for example, the lot size should be increased gradually, as well as you keep your adding a position in different levels. So that means that normally what happens, many traders do mistakes when the market goes against them. They try to average a position on the loss side. That means what happens, like it's you're multiplying a loss. That means from 1% or 2%, you're increasing to double your loss, like 4%, like you can increasing to 8%. That goes on accumulating your loss. So that's what exactly normally happens, and where the risk is majorly accumulated on the trading account. So this allows to increase your profits, reduce risk, limit losses when market turns against you. So that means the two types of scaling is there. Like a scaling is like in and scaling out. So of course the scaling is the one in and out. Traders require a proper money management, very disciplined way to trade, and it should be a trending market. Especially should continue the trending markets. If it is a sideway, definitely you have to exit from your positions, because when you're one side move and you're going to add your position on different levels, for example, with some indicators or some strategy, like adding a 50 points above, you're adding some more additional position be adding on your account. So this also to be followed properly. So this is how exactly the scaling, it's in and out strategy. But definitely the market should be on your trending side. Either side, it can be bullish or can be bearish, but still it gives a good result to maximize the n number of profits for you. So next one is that like where is about the leverage. So most are very curious about the leverage, basically, because the traders would like to go for leverage. They want high leverages. So basically, high leverage means is high risk. It's very simple, very simple. That means you get the products, you get you into the market with a huge number of positions, a huge number of lots jumping into the market, which you want to take advantage of the leverage. That's true, but still the same is like high risk. So basically, it's high leverage means gives high risk on this. So when a market favor in a trade, the leverage gives you gains. Obvious, like if you have a huge lots, like you take a positions. Normally, the leverage market is always a huge risk. So basically, when you have huge lots, number of lots you've been adding in some place with the help of leverage. When the market gives a favor, when favor sides definitely gives a lot of gains to you. But same time, when a market goes a slightly downside or against you, it gives a lot of multiple loss to you. So that's how exactly the leverage is a very important point to be give a comfortable level to get into that. If you're a caution or inexperienced investor, maybe beginner or a trader, always try to go with a low level, very low level of leverage to feel comfortable with adapt to the markets. So you will come to know, because leverage protect your account basically from the huge loss or from the major movements happens in the markets. So and comparing with the professional traders, because the professional trader will have some good strategies. They'll be keep your plan very clean and neat. So they have kept your money management very properly. Enough funding is there, and keeping enough balance in the account and accumulating only the part of the margin to the trading. So that helps you. So there are a lot of range of leverage available in the markets, as we all as gives the same thing, like 1:50, 1:100, or 200 extra. So different level of range. So but leverage plays a major role how to how to execute the trade with limited margins. So let's move on the next one, which regular check in trading journals. Normally what happens, most of the traders get scared when they see their trading logs or something, but it's must to check. That gives you exactly, and especially the traders who are professional traders, or maybe you have forming a trading strategy. Even that at must to know about the journals, like how you trade, how the performance of your trading strategy. A trading journal is a complete record of all your trading activities overall time. For example, you've been trading for 6 months or for 1 year time or maybe a couple of years or something like that, whatever may be, you have to have a proper assess to your overall performance to know where you stand in your trading. For example, you started trading for a month basis. Okay, in monthly, what you have been implemented, what type of strategy have been started in trading. So based on this trading strategy, what the result has been given on your trading. So you have to check regularly how exactly it happens. So this really helps to follow the existing strategy to be on a better performance if it is a better performance. But in case it's giving a poor performance on a strategy, definitely you have to exit from the strategy and find for the new strategy to implement. So what we're discussing today now, it's a very important highlighted points, like it's very important on a risk management side. I guess you all enjoyed. Hope, thank you everyone, and thanks Wael.
Thank you, Sai. So everyone, if you have any questions, please write them down so we can discuss them. Okay, Sai, someone is asking, what is the right leverage for a beginner trader?
Yeah, that's right. What is the right leverage for the beginner trader, right? As you're a beginner, you always keep as 1:100 is the best, one of the best, where you can maintaining your margin with leverage, you know. So that's your perfect place to start with this. So over trading also is not good actually. If you feel like you still feel that your risk is want to be reduced, so definitely you could go below that. Nothing wrong in that to keeping a leverage to be down. So that's how exactly.
Even sometimes if a trader has a leverage of on his account of 1 to 200, but it's better to always, like for example, take a trade of 0.01 and not a micro lot and not even a mini lot. So even if he has a high purchasing power on his account, but he's abiding to his risk management rules, so he'd be using a less volume size. What can give you confidence in the market? It's a very good question, very nice question. Mainly what can give you confidence is mostly I spent my early trading times like 8-9 years ago. It was mostly screening. So if you go mainly for screening, the screening time can give you more confidence since you always reckon you'll be more familiar with what's happening. You'll be more you'd be more confident when you see certain price moves, and also you'd be more familiar with the price patterns that are repeating themselves more often every now and then. So so that's how. And always, but also you have to make sure for something. If you gain confidence in the market, you better also watch out for the overconfidence. So if you were having a winning streak, like for example 5, 6, 7, 8 winning trades, a trader usually here he becomes overconfident and starts missing out on his risk management techniques. So he go for example a higher leverage, a higher volume size. He won't abide by his stop losses and take profits. So also overconfidence is bad, and also lack of confidence is bad. So always make sure to have a balance, and this balance could be earned by more experience. Does the market always obey trends, breakouts, and other? Usually, when the market is trending, if the market is not trending, it is going for range trading, and if the market is not ranging, it is trending and breaking out from a certain range. So always there's this type of action in the market, either range markets or range trading or breakout trading and trending markets. So it's always the market is always like this. What's best is finding a trading strategy that can, for example, if it is based on range trading, to minimize your losses the most when the market is breaking out. And if you choose another system, for example, a breakout system, to make sure that it will you will incur minimum losses if the market is moving in range. So here, if you were able to find this this small like to balance your strategy in order to avoid these losses when the market is opposing your trading style, here you'll be reaching a very positive and very good trading performance. Yeah, so I'm gonna give you another an example about the range. When the market is I don't know if I just mentioned if you had any technical difficulties in hearing me. So when the market is moving in trends, if the market is not moving in trends, it's usually trending, and if the market is usually trending is not trending, it is moving in trends. So always the market is set between range and breakouts. What you can make the best trading strategy would be, when choosing a trading style, trying to filter the signals that would make you lose. For example, if you are basing your trading strategy on range trading, you have to find some filters that would help you avoid the losses that you could incur if the market is moving in a different trading style, if the market is going for a breakout, and vice versa. If you are choosing a breakout trading strategy, make sure to have some filters that will help you avoid taking those false breakout signals, so you'd have better performance. It's just a small example in front of us here with gold. As we said, the range traders, they were making money here. If they were able to find filters that they would avoid this breakout here, so they will be able to sustain their profits that they made here, and even add to the profits and have better performance. Also, for breakout traders, those who were believing that the market is going to break out from this resistance point here, and it turned out to be a false breakout, and also here it turned out to be a false breakout. So if they find a filter, or they can filter these two false breakouts, they would have better performances here. The market was able to break above the resistance and moved higher. So it's always about finding the best filtration that will help you sustain the market when it goes against you, when it goes against your trading style. Explain Fibonacci, how Fibonacci can be used. We talked about Fibonacci. You can find uh, the rerun for the Fibonacci on our social media channels, but I'm gonna give a small, fast example for Fibonacci. The Fibonacci is from an idea that the market's gonna retrace certain moves. So for example, so let's say the market here is moving up, so we go for the last swing. You can also go for the last swing by using the zigzag indicator. So if you just plot the zigzag indicator here, you can set the Fibonacci on these swings in zigzag. For example, this one here, uh, or you can take, for example, this one here. So also you can use the zigzag in order to choose the swing that you are checking. So if you are using Fibonacci here, the market is retracing towards a certain level, and let's say you have a moving average. So this is a moving average 200. So let's choose a faster one. So we're choosing 100. The 100 moving average is telling us that the trend is up. So you have to look for setbacks in order to join this trend. So you go for Fibonacci retracements, you apply the Fibonacci retracement and start looking for these levels here in order to re-enter the market and join the trend. So if you can see here, the 38.2 retracement is similar to the previous resistance that was here, around 1760. So most of the traders, they will believe that if the market retraces lower towards 1760, they can buy and join the trend, and maybe the price would retest the high of 1818. So this is a small example on how you can use the Fibonacci retracement when trading with the trend. Any other questions? Okay, perfect. I believe this is it for today. Sai, do you have anything to add?
No, thank you so much for everyone.
Okay, so everyone, if you have any questions, you can write an email to webinar@icm.com or support@icm.com, and we'd be glad to help you. On Monday, hopefully, we're going to have our week ahead session. And on next Wednesday, we're going to have also an educational webinar. So stay tuned till then.